Hello and welcome to episode 60 of Prosperity by the Pint. I'm your host, Brice Carter, certified financial planner, chartered financial consultant, certified investment management analyst, and self-proclaimed millennial money expert. This is the podcast where we talk about money, investing, business, and life success, all while having a cold beer. The cold beer of the week is from New Belgium, which is one of my favorite breweries out of Colorado, and it is their Glütiny Pale Ale. And it says crafted to remove gluten. I didn't realize it was one of those gluten-free beers when I grabbed it, but that's okay. There it is. Cheers. Let's see. It's okay. I think the removal of the gluten made it less delicious, but it's all right. It's a very light for a pale ale. Not a lot of hop to it, but I don't know. We'll see as we get to the bottom. This week, I wanted to talk about the key differences between assets and goods. So assets and goods. This is, to me, one of the keys to accumulating wealth over time. And so I've talked about budgeting. I've talked about investing. I've talked about those things quite a bit. But in my view, this is just a simple concept that can help you reshape the way you think about spending, investing, saving, right? And again, Brice's view here is that buying assets versus buying goods is the key differentiator between those that accumulate wealth and are financially successful and those that are not financially successful. Those people tend to buy goods. So what is the difference between assets and goods? Now, there's an accounting definition, and it gets into long-term assets, short-term assets, liquidity assets, durable goods, non-durable goods, depreciating, non-depreciating, et cetera, et cetera. That's the accounting definition, and there's a bunch of different definitions in there. Try this beer again. I feel like it deserves another chance. All right, I'm warming up to it a little bit. It still just lacks a punch, lacks a flavor. But their New Belgian Ranger, Imperial Ranger, is one of my favorite beers of all time. But so that's the accounting definition. There's a lot of different things going on there. This is my simple definition. So a good is an object that appreciates in value and has little to no tangible value beyond recreation or personal use. An asset, on the other hand, is an object, property, or investment that is intended to generate income or appreciate in value. It is bought for the purpose of accumulating wealth as opposed to personal use. So a good is stuff, and an asset is an investment. That's the short, simple version. A good is stuff, and an asset is an investment. One appreciates in value, one depreciates in value. Appreciate versus depreciate. So we make wish lists about goods, right? Like the new iPhone comes out, and you might say, I really want to can't wait to get the new iPhone. People wait in line for it. I really want to get new furniture in the living room or a new bedroom set. I want to get a new bike, a car, a stereo, whatever your thing is, right? And we even put together lists like for birthdays and Christmases of goods that we want. And most of the stuff is just that. It's stuff. We're accumulating more stuff than we used to. But very rarely do you hear people talking about accumulating goods, right? You do hear people talking about accumulating goods. You don't very often hear them talk about accumulating assets, right? So it's not often that you're sitting having dinner with some friends at a restaurant. It's not very often you're going to be doing that recently. Have not done that much recently at all. But it's not very often you hear people saying, yeah, I'm saving up for Amazon stock. I really want to buy another share of Amazon. Or hear people say that I made a list for my birthday of how much I want to save so that I can buy this rental property down the road that's going for sale, right? We just don't think, we think about goods and assets differently. It could be the size of the purchase, but like I said, it's not often you hear people say, I'm saving up so I can buy shares of Amazon or Apple or just the S&P 500 index fund. People don't get excited about that. They get excited about goods, the stuff they use, these things, right? Our phones that we play with all the time. We get excited about goods. We don't get excited about assets. But if we were to shift our thinking, right? and say, I'm really looking forward to getting paid this week because I am going to be able to save and buy a couple more gold coins or gold bars to save and work as a store of my value and act as a hedge against inflation. If we thought about our assets the way we think about our goods and looked forward to purchasing them, that simple mind shift right there. Like if you got excited to get to the end of the month and have excess money and be purchasing some of your favorite stocks because you also like their products. If that was your mindset, for every product that you were buying, you were also excited to buy the stock of that company. I think the way in which you could accumulate wealth would be drastically different, right? I just, and the wealthier you are and the more income you have, it's much easier to buy assets, right? Because there's only so many goods that you can buy, and goods are going to make up a smaller and smaller and smaller percentage of your income as you are making a larger and larger income, right? Like $1,000 iPhone is a lot of money for somebody that makes $32,000 a year. It is absolutely nothing to somebody that makes $1.2 million a year, right? So it's much easier for them to have disposable income that can go towards assets as opposed to excess goods. But if you shift this mindset and got excited about the asset component, just think of the wealth that you could accumulate, right? If you're actively saving in a situation to where I want to buy more shares of Amazon, which is $2,400 a share right now, rough $400 a share is not chump change by any means, right? So you do, that for many people have to save to do that, which it is completely fine. I mean, just get excited about it, right? So I think by shifting our mindset a little bit towards assets and getting excited about assets, we're much more likely to accumulate them. So one of the things that I personally get a little bit excited about is I've talked about how I budget in the past a little bit, but I'll just bring it up again because I think it's valuable, and I'm going to take a beer break again. This it's like I said, it's not bad, but it's more like a hoppy lager than a pale ale. It just doesn't have a whole lot of flavor. Gluttony. This is not gluttonous by any means. So I've talked about how I budget, and the way I budget is I have a fixed amount that I like to keep in my checking account. Let's just call that amount $5,000. And every month money comes in. Let's just say, you just stick with easy numbers. $5,000 a month comes in, and every month money goes out for expenses, bills, mortgage, insurance, health insurance, whatever stuff, stuff again, right? And let's say $6,000 a month that's coming in. That means at the end of the month I should have $6,000 in my checking account instead of the $5,000 I typically keep. I transfer that excess money, that $1,000, to my savings account. When my savings account is above certain thresholds, I go ahead and transfer some of that into my investment accounts. That's how simple it is. Now, if I'm saving for a larger purchase, let's say I'm saving for new living room furniture, for example, and that new living room furniture is going to be $2,400. Now, I'm just going to have my savings account accumulate $2,400 above and beyond where I like to keep it at, and so that's how I budget. That it's super simple. I can explain it to you. I just did that in about 2 minutes. Now, the thing that I'd like to point out with this is when I have the excess, when I have that $1,000 extra or whatever in my savings account, and I get to throw that into my investment account, I actually get really excited about that. I get to go shopping for assets. Maybe that asset is just, the Spider Total Stock Market Fund. Maybe it is, and again, when talking about individual stocks, I recommend, having a disciplined investment policy statement, which I incorporate very disciplined investment principles into my financial plan. But maybe it is that the market has crashed because of COVID-19 and Amazon went from, $2,400 a share to $1,700 a share. So I'll pick up one. Right? So I can get excited about that. I can get excited about the assets I earn. And then I can get further more excited about them when I know they earn dividends, right? So I don't think dividends are the end all be all. A dividend is merely a company sharing the profit with the shareholders, right? So they're taking a portion of their profit and they're sending it to you. I don't get super excited about dividends because if a company is profitable and they're taking that money and they're investing in research and development and product development and infrastructure and things like that are going to make them more profitable down the line, I'm fine with that too. But what I do kind of get excited about is a dividend where I can look at an investment which some of the oil stocks, I'm not recommending oil stocks by any means, you can buy right now and get 5, 6, 7% dividends, annual dividends to them. So you could have an asset that you put $1,000 in and just cash flow, making $50, $60 a year on it, just in cash flow before it even appreciates in value. So that's my mindset. Is I get excited about buying this stuff. I get excited about buying assets because you get that compound interest working, and I can buy, when I buy a product off of Amazon, I can know that I'm actually a part owner of the profits of that product. Now it's going to be 1/10 of a billionth of a percent of a owner, but still, right? So I can get excited about that. So I think shifting your mindset a little bit from goods to assets and not looking nearly as much as accumulating goods, because many of the things that we buy get relatively short amount of use and then they're done, right? And instead of having to have the most recent phone or the most recent earbuds or watch or just stuff, think and try to get a little bit excited about buying assets. So asset purchases as opposed to good purchases. That's a good way of accumulating wealth and raising your income. That's going to do it for this week's episode of Prosperity by the Pint. I'm your host, Brice Carter. Hope you're doing well. Don't forget to follow us. Spotify, YouTube, Facebook, iTunes, Stitcher, Spotify. Already said that. Pandora, wherever you listen, that's where we are. Cheers. The topics that I discuss in this podcast are meant to be general information and educational only. I'm not giving you specific advice because I don't know you personally. In order to give you specific advice, you should work with an advisor or someone that can learn your specific situation and give you advice that applies to you. If I talk about a specific security, please keep in mind I'm not recommending that security. And don't forget, investing involves risk. When you invest, there's always the possibility of losing capital, which is why you should consult with a qualified, licensed financial advisor prior to investing.